Hello fellow boomers, welcome back to our channel. Picture this, it's January 2026, a Fortune 500 company finalizes its AI budget for the year, hundreds of millions of dollars, carefully modeled, approved by the CFO, signed off by the board. 4 months later, it's gone. Not we're tracking a little hot, not we'll need a top-up in Q4. Gone, spent, lit on fire. The company is Uber. The line item that ate everything? An AI coding tool called Claude Code, and here's the wild part, Uber's own engineers were celebrating it. They got onto leaderboards for using it the most, their managers cheered them on, their CTO encouraged it. Then the bill came in. This isn't a story about one company making a math mistake. It's the story of how in 2026, the entire software industry quietly walked into the most expensive productivity trade in its history, and most of the executives signing the checks still don't understand what they bought. Stick around. By the end of this video, you'll understand exactly what happened at Uber, why Goldman Sachs, JP Morgan, Google, Meta, and Shopify are all walking into different versions of the same situation, and the one piece of math nobody on the finance side seems to be doing. Let's start with the Uber story. We'll start with the numbers because they're almost cartoonish. In December 2025, Uber rolled out access to Claude Code, Anthropic's command-line AI coding agent, across its engineering organization, about 5,000 engineers. By February, usage had doubled. By April, Claude Code adoption inside Uber had jumped from 32% of engineers to 84%. Here's where it gets interesting. By that same point, 95% of Uber engineers were using some AI coding tool every single month. About 70% of all the code being committed to Uber's repositories was originating from AI, and 11% of live backend updates, actual changes pushed into the running production system, were AI written. That is a staggering rate of change. Most companies don't shift their core engineering workflow that fast in a decade. Now the cost side. Monthly API costs per engineer range from $500 to $2,000. Multiply that across thousands of developers, with usage doubling every couple of months, and you get the headline. Uber blew through its entire 2026 AI budget by April. Estimates of the total spend land around the $3.4 billion mark on the AI line. Uber's CTO, Praveen Nepali Naga, came out and said the company was back to the drawing board. Not because the tools didn't work, they worked spectacularly. The problem was the opposite. They worked so well that engineers couldn't stop using them. So, what actually happened? 3 things, layered on top of each other. The first thing is the pricing model. Claude Code runs on consumption-based pricing. Every token in, every token out, every line of code reviewed, refactored, explained, every file the agent reads to understand context. It all draws from a running tab. There is no flat seat price. There is no buffet. It's a taxi meter, and the meter runs faster the more useful the tool becomes. The second thing is the agentic shift. Old-school AI coding tools. Think early GitHub Copilot. Auto-completed a line at a time. A developer typed, the model suggested, you accepted or rejected. Cheap. Predictable. The new generation Claude Code in particular doesn't auto-complete. It executes. You give it a task and it spawns parallel agents that read dozens of files, run tests, refactor across modules, retry when they fail. A single fix this bug prompt can burn through millions of tokens. One developer doing one thoughtful task in the morning can spend more in API fees than they used to spend in a month of autocomplete. The third thing, and this is the one finance teams are not yet emotionally ready for, is the incentive structure. Uber didn't just permit AI tool usage, the company actively encouraged it. There were internal leaderboards ranking engineers by Claude Code usage. Adoption was a positive signal in performance reviews. So you had thousands of engineers competing to use a tool that bills per token, while management cheered them on, while finance assumed adoption would follow a normal S-curve. It didn't. It went vertical. Now here's the part the trade press mostly missed. Uber didn't make a uniquely bad decision. Uber just hit the wall first because it had the most engineers and the most aggressive rollout. Almost every major tech company is on the same trajectory. Let's do a tour. Google. Sundar Pichai went on stage and said that 75% of new code at Google is now AI generated. That number was 25% at the end of 2024 and 50% in mid-2025. Google's engineers are no longer primarily writing code. They are reviewing what an AI wrote. Meta. Internal targets for 2026 expect 65% of Meta's engineers to use AI for more than 3/4 of the code they commit. Meta has its own internal coding agent. They're not buying their way out of this, they're building the meter. Snap, 65% of new code is AI generated. Anthropic itself, reportedly close to 100% of its own code is written with AI assistance. Yes, the company selling the picks and shovels is using its own picks and shovels for everything. Goldman Sachs. This one is fascinating. Goldman is rolling out autonomous AI coders across roughly 12,000 developers, projecting 3 to 4 times productivity gains. They've adopted Devon, an autonomous AI software engineer, and they're treating it as a digital workforce. Goldman has even reshaped its balance sheet partly to free up capital for AI infrastructure, pulling tens of billions back from consumer portfolio investments. JP Morgan Chase, a $20 billion technology budget for 2026, of which AI is supposed to deliver $2.5 billion in annual value. About 65,000 engineers and technologists are now formally evaluated, in part, on their AI tool adoption. Internal coding assistants have already produced 10 to 20% productivity gains. Salesforce. CEO Mark Benioff says AI is doing somewhere between 30 and 50% of all work at the company. Shopify. This may be the cleanest case study after Uber. CEO Toby Lutka wrote an internal memo declaring that reflexive AI usage is now a baseline expectation. Managers can't request more headcount without first proving the work can't be done by AI. Shopify built an internal proxy layer in front of every major AI provider, dozens of MCP servers, and shipped a public-facing AI toolkit that lets external developers run their store with Claude Code, Codex, Cursor, or VS Code agents. Across these companies, one pattern is consistent. Adoption is faster than the budget cycle. Spend is more elastic than the procurement model. And nobody on the finance side knows how to size a line item for a tool whose cost depends on how creative your engineers are willing to be. Here's the systemic picture. Roughly 85% of organizations misestimate their AI costs by more than 10%. About a quarter of them are off by 50% or more. More than 8 in 10 companies report that AI costs have eroded gross margins by more than 6%. Over a quarter day, margins dropped by 16% or more. This is not because CFOs are bad at math, it's because the unit they were given to budget against, seats, does not describe the thing they're buying anymore. 12 months ago, an AI coding tool was a subscription, $20 a month per developer, predictable, bookable, easy to cap. Today, an AI coding tool is a fleet of autonomous agents that can spend more in a single afternoon than a human developer earns in a week. The same engineer with the same login can produce a $50 bill on Monday and a $5,000 bill on Friday, depending on what they're working on. There is no seat. There is a meter, and the meter scales with ambition. Anthropic, for its part, has been unusually direct about this. In early 2026, they shifted to fully usage-based billing. No flat enterprise tier hiding the consumption curve. Their argument is that pricing must reflect cost, because if you let customers buy unlimited usage at a fixed price, you go bankrupt the moment those customers get good at using the tool. Anthropic's annualized revenue went from $1 billion in late 2024 to roughly $14 billion in February 2026 to about $19 billion by March. Of that, Claude Code alone is reportedly $2.5 billion in annualized revenue, more than half the enterprise number. Approximately 4% of all public commits on GitHub are now authored by Claude Code, with projections above 20% by year-end. That curve doesn't bend by accident. That curve bends because customers like Uber decided the tool was worth using as much as humanly possible, and then their humans got better at using it. Here's the math problem that the Uber story really exposes. Imagine you run engineering at a 5,000-person company. Your engineers cost, say, $300,000 fully loaded each. That is a $1.5 billion engineering payroll. If an AI coding tool makes each of those engineers 30% more productive, the value created, purely in time and output terms, is something like $450 million a year. If it makes them 50% more productive, you are looking at $750 million. Against that, Uber's $3.4 billion AI line looks insane. But notice, that's assuming the productivity number is real and that the company actually captures the gain. Two big assumptions. This is the question every company on the list above is now wrestling with, even if they won't say it on an earnings call. If AI coding tools are 30 to 50% productivity multipliers, and that's roughly what Goldman, JP Morgan, Salesforce, and Google are publicly claiming, then they are unambiguously worth the money, even at Uber's spend level. The bill is huge, but the labor leverage is bigger if those productivity claims are inflated by a factor of 2 or 3, which is plausible because nobody has audited them properly. Then large parts of the industry just spent more on tokens than they would have spent on engineers, and they have nothing to show for it but slightly faster pull request cycles and a lot of code written by something that doesn't get tired. Right now, we don't know which of those two worlds we live in. The Uber story is so striking partly because it's the first time a major company has been forced to publicly reckon with that uncertainty, mid-flight, with the bill already on the table. A few predictions to leave you with. None of these are wild. They're all variations of moves already starting in the market. First, internal proxies become standard. Shopify already runs one. Uber will build one. Every Fortune 500 will have, by end of 2026, a layer between engineers and the AI providers that lets them rate limit, track per team spend, and enforce model selection. The most expensive model, typically the top-tier reasoning model, will get gated behind approval. Cheap models will handle the everyday stuff. Second, finance gets a new role. Expect a wave of new titles: AI cost engineer, FinOps for AI, model spend analyst, sitting in finance organizations and effectively running budgets for token consumption, the same way cloud FinOps teams ran budgets for compute spend in the last decade. The playbook is the same, the asset is just denser. Third, the consumption pricing fight isn't over. Customers are going to push hard for predictable enterprise pricing. Anthropic and others are going to push back because the underlying compute is genuinely consumption-based, and they cannot afford to subsidize unlimited use. The compromise will look like committed use contracts, prepay big buckets of tokens at a discount with overage rates above the bucket, exactly like the cloud market figured out in the early 2010s. Fourth, and this is the one nobody is saying out loud, some of these productivity claims are going to come back down. Google says 75% of code is AI written. That doesn't mean engineering output went up 4x. A huge fraction of that code is boilerplate scaffolding, and test cases an LLM would happily generate at unlimited length whether the human needed it or not. The real question, how much customer-facing value did AI actually add, is much harder, and we will spend the next 2 years arguing about it. So, here's what the Uber story is when you strip the headline away. It is not a story about a tool that's too expensive. It's a story about the first generation of software companies that genuinely treat AI coding as a primary input, and the first generation of finance teams that have to figure out how to budget for an input that gets more expensive the better it works. Uber blew its budget because the tool was good. The same dynamic is playing out, more quietly, at Goldman, at JP Morgan, at Google, at Meta, at Shopify, and at every other company in your portfolio that's announced an AI strategy in the last 18 months. The companies that survive this transition will be the ones that put proxies in front of the meter, that build the FinOps muscle to track per team spend, that compare AI costs to actual revenue impact rather than theoretical productivity multipliers, and that stop treating more usage equals better as an inherent good. The companies that don't will keep finding every spring that the budget they wrote in January is already gone. If you're watching this and you're a developer, congratulations, you've never been more leveraged. If you're watching this, and you write the checks for developers, welcome to the most interesting line item in your P&L. We'll keep watching the numbers. Hit subscribe if you want to see how this plays out across the rest of 2026, because if Uber is the first company to hit this wall, they will absolutely not be the last.